when in reality it was the bank's deliberate actions that were inflicting the damage. Biddle believed the strategy would work. By engineering widespread distress, he expected public opinion and Congress to turn against Jackson, forcing a reversal of the deposit removal. In a private letter to Henry Clay in December 1833, Biddle made his thinking explicit, saying, "This will cause such distress universally that the people will call for the recharter of the bank." Jackson's opponents in Congress, particularly Henry Clay and Daniel Webster, seized on the resulting disruption. They argued that Jackson's removal of deposits was reckless, unlawful, and directly responsible for the economic pain spreading across the country. Jackson's allies countered sharply. They accused Biddle of deliberate financial strangulation, portraying him as an unelected autocrat weaponizing credit to punish the public for political defiance. The charge was simple and devastating. The bank was making the people suffer to restore its own power. Public sentiment began to shift. Working men and small farmers, already distrustful of financial elites, saw confirmation of Jackson's warnings. Even moderates, once sympathetic to the bank, began to question whether so much economic power should rest in the hands of a single, unelected financier. One story, repeated in partisan newspapers and later political recollections, captured the mood. A member of Congress, formerly friendly to the bank, claimed to have overheard Biddle boast at a social gathering that he could bring the country to its knees by tightening credit, and that once distress spread, order would be restored. Whether literal or apocryphal, the story resonated. It crystallized a growing perception that Biddle viewed the nation's economy as a lever of political control. For many observers, this was the danger Jackson had warned against from the beginning, that a single financial institution, led by an unelected man, could hold the republic hostage to its will. Once again, attacks meant to break Jackson backfired. Sympathy for the bank eroded. Opposition fractured. And under mounting public pressure, Biddle was eventually forced to ease the credit contraction, retreating from financial warfare and turning back toward the political arena in search of another way to strike at Jackson. With financial retaliation failing to break Jackson's support, the battle shifted arenas. If the bank could not force surrender through credit, then Jackson would be challenged through institutions. Henry Clay seized the opening. Clay, long the intellectual architect of the American system, and now Jackson's chief political rival, reframed the conflict not as a struggle over banking, but as a crisis of constitutional order. The issue, he argued, was no longer the bank. It was the presidency itself. Jackson's removal of the deposits, Clay claimed, represented an abuse of executive power, a dangerous precedent that placed the will of one man above Congress, the law, and the Constitution. Clay was joined by Daniel Webster and other national Republicans, soon to consolidate as the Whig Party. Together, they launched a formal Senate offensive. Their aim was clear: to brand Jackson not merely as wrong, but as illegitimate. In March 1834, the attack was formalized. The Senate passed a resolution of censure, a symbolic but serious rebuke, declaring that Andrew Jackson had assumed upon himself authority and power not conferred by the Constitution and laws. It was the first time in American history that a president had been formally censured by Congress. Importantly, the censure did not reverse Jackson's actions. It did not restore the deposits. It did not revive the bank. What it sought to do instead was shape perception, to fix in the public mind the image Jackson's enemies had been cultivating all along: a lawless executive, trampling institutions, ruling by personal will. But here, too, the strategy misfired. The censure passed the Senate, but it never reached the House, where Jackson's supporters held firm. To the president's base, the vote looked less like a defense of the Constitution and more like elite retaliation, a political punishment imposed by men who had lost both the election and the argument. Jackson responded with characteristic defiance. He refused to acknowledge the censure as legitimate. Instead, he ordered his allies to enter a formal protest into the Senate Journal, rejecting the charge outright, and once again appealing over the heads of institutions to the people themselves. And the people heard him, they listened, and they stood with Jackson. The message was unmistakable. What had begun as a dispute over banking had become something far larger, a struggle over sovereignty itself, whether power belonged to institutions, foreign-owned banks, unelected financiers, compromised elites, or to the people who elected their president. The bank had lost its money. Its allies had failed to break Jackson politically. And now, even the Senate's authority was being openly challenged. Yet even as Jackson prevailed, politically, financially, and institutionally, the war was not over. Because beneath the visible battles in Congress and the newspapers, another struggle was unfolding, quieter, more technical, and far harder to fight. Not a conflict between men, but between rules, between incentives, between metals. The American monetary system Jackson inherited was still bound by an outdated constraint, a fixed legal ratio between gold and silver. Under U.S. law, gold and silver were treated as equals in circulation, locked together at a 15-to-1 ratio. That ratio had been set in the early Republic, carried over from late 18th century British assumptions, and formalized in American law in the 1790s. But the world had moved on. On international markets, gold was becoming more valuable relative to silver. In Britain, the price of gold was not fixed by law, but adjusted continuously, with each private banking house setting their prices dynamically, not by law but by supply and demand, trade flows, credit needs, and the realities of empire. Prices moved, ratios flexed, incentives adjusted. When two forms of money circulate side by side, but one carries a legal face value that no longer matches its true worth, a predictable pattern emerges. In this case, gold was worth more abroad than the value stamped onto federally issued American coins. And when that happens, people do what incentives demand. They hoard the more valuable money and spend the less valuable one, a principle later formalized as Gresham's Law. This dynamic had been observed for centuries, but for Americans living through it in the early Republic, it was simply a lived experience. Silver stayed, gold left, not because of panic, not because of conspiracy, but because the rules made it profitable for it to do so. Much of that gold was melted down by bankers and speculators who understood the system, sold abroad at higher market prices, and pocketed the difference. The law did not prevent this behavior. It encouraged it. And so, even as Jackson was defeating the bank in public view, hard money was quietly draining out of the country.